Hello everyone, this is Renzo again with another video about the stock market and how to trade in the stock market. First of all, I want to thank everyone who has subscribed to my channel so far, and the ones that have left me messages or comments or contacted me personally, encouraging me and giving me positive feedback and positive vibes. I really appreciate it. And all I'm doing here is sharing what I know with you guys because knowledge is power. And honestly, all the information about trading the stock market is free. So no one should be paying thousands and thousands of money to learn how to do this because honestly, it's not that hard. The main thing is that you need to understand the concepts and you need to have a strategy and also a risk reward plan when you trade in the stock market. But anyways, so today we're going to continue with our technical analysis videos and lessons. And today we are going to talk about the moving averages. Okay, so what is a moving average? For that, I'm going to bring up here this website, Investopedia. So if you want to learn all these definitions and terms and strategies and indicators and what they do and what they for, just go to this website, Investopedia. It's free, and it tells you everything you need to know. So all you got to do, go to Investopedia, go here to the search engine right over here on the right, and type moving averages. Okay, so what is a moving average? A moving average pretty much helps traders understand the trend. Remember, we talked about the trend. Always trade with the trend. The trend is your friend. So if the trend is going up, that means that you should always buy for a long position. So buy low, sell high. If the trend starts to continue to go down or starts to go down, if you have a long position, that might be the point for you to exit. And also let us understand whether or not the trend is sideways. So moving averages, pretty much what they do is they smooth out the price action for a specific time frame. So if you see here, this is the chart of Apple, the daily chart of Apple, and I still have some of the support and resistance that we drew previously on all the videos. And if you see, we have some ups and downs and ups and downs and ups and downs, and then we have a down right here, and it came back up and down and then went up, right? So we can say, okay, well, by looking at this, is it going up or is it going down or is it sideways? So if we only had some information on the chart, we're not going to be able to determine that. If we don't know if this was a drop completely to the downside or if this was a drop completely to the downside, we will not be able to place entries right here or entries right over here. So that's why we use moving averages. So just to give you an example, let's go to the internet. Okay, and I'm gonna go to this website. This website is called Finviz. Okay, so Finviz, see, let me go back if it lets me go back. Well, all right, so Finviz is a free website where you can also find stocks. Okay, so this is the stock of Apple and it gives you a whole chart. So if you see, it has these lines here at the bottom by the price. So that is a moving average. There's one moving average, two moving averages, three moving averages. So let's go to another website. This is stockcharts.com. Okay, these websites are free, and this is just in case you already have some sort of investment and you don't want to open TD Ameritrade or download Thinkorswim. You can use these other free websites, and the moving averages are already populated. So if you see, this is Apple. Also, we have a daily period, and we have one moving average, blue, and if you see, the blue here represents the 50 moving average, and then we have this red one that represents the 200 moving average. Okay, so now to my Thinkorswim. If you're using Thinkorswim, we're gonna go here to the Edit Studies tab, and we're gonna type exponential moving average, and it's gonna give you here two options. Click on the second one that says moving average exponential. So double click it one time, two times, three times. Okay, so now what we're going to do is going to move here to the right side and going to go to the first one, click on the gear icon. Okay, and we're going to change this from length 9, we're going to change that to 20. Let's leave it that color, this blue, magenta, whatever you want to call it. I don't know if it's magenta, but I'm going to make it the width, I'm going to make it 4 so we can see it. I'm going to click OK. I'm going to go to the second one, click on the gear icon, and I want to make this one the 50 moving average. I'm going to make the width 4 so we can see it, and the color, let's say we want to make that one, let's make it this yellow. All right, and we're going to go to the third one, and we're going to change the length again to 200, and now we're going to make the 200 purple. Okay, we're going to make the width 4. Okay, and we're going to hit apply and OK, and now we have our moving averages. Okay, these are thick so we can see it, but usually, you just put a thin line, a 1 or a 2. Right now it's 5, so that we can see it on the video. Okay, so moving averages help you understand the overall trend of the market. If you see on this area right here, all this right here, okay, we see that the moving averages were going up and the price stayed above the moving averages. So if remember, this is the 20, this is the 50, this is the 200. Here it crossed down and stayed in between these two averages, and it went back up and it went back down, and it went above it again, and it bounced and continued to go up, right? So let me explain what the 20 moving average is, what the 50, and what the 200. 50 means that 20 means that it takes 20 days of data, of price data, and that's an average, and it populates the average. The 50 takes 50 days of data, and the 200 takes the last 200 days of data. Okay, so why do we use moving averages? We use moving averages to also give us better confirmation for potential entries and potential exits. So let's combine the moving averages with what we learned about the MACD and the RSI. Okay, so we have the RSI here and the MACD right down there. So I'm going to move down to the 4-hour chart, okay, and see what we can find. All right, so if we look in here, we see that the market was right in the moving averages, okay, and then it broke below 1 and it came down. But when it came down, it found support, okay, and when it found support, we see that the RSI was oversold right over here, and we see that the MACD started to, it was red, and then it started to turn into the green for a potential crossover. So let me stop right there. I just said that the MACD went down and it hit this 200 moving average, exponential moving average, and it found support. That is correct. So moving averages can also be used for support and resistance. I do not recommend to solely base your support and resistance on the moving averages, but if you see in this area right over here, the price found support on the moving average. And when it broke below these two, then it found support on the next moving average. So let's go back to our example. It breaks down from these two, finds support. We see it's oversold. Let's wait for confirmation. And then it starts on the MACD down at the bottom. It starts going into the green. And then we have this right here where the price goes above the moving averages one more time, and then it shoots up to the upside. If we see right here, the price comes up and then it bounces, because remember, everything that goes up must come down at some point, but it doesn't mean that it's going to come down and collapse. So here in this example, it comes up, it comes down, and if you wanted to trade or add to your positions, you could have waited here until you get confirmation, right? Remember the word confirmation, and then add to your position. Or if you wanted to play a safe trade, and if you wanted to get out, then you get out once it crosses the moving averages. So from here to here, let's see, that would have been $95 to $110, so that's not bad. So depending on the size of your position, that could have been a very large amount of money. Okay, so now let's look at this scenario over here. We see that it's an overbought condition, so it's all the way at the high, and then the MACD is all the way high. So we said, okay, let's see if this is gonna come back down, and it's probably gonna come back down to this area over here of support and resistance. Okay, but we see that comes down to the moving average, and it fails to break the moving average. In fact, if we look at the past, we know that the moving average, this 20 period moving average, is been serving as support. So we can make an assumption, okay? If it comes to the moving average and it bounces back up and it breaks this area, it's gonna continue to go up. Why do we have this assumption that the 20 period moving average could act as a support and or resistance? Because past data tells us that. Now, not all past performance can guarantee future performance, but trading in the stock market should not be complicated. We should not make it complicated. Let's look at previous data and use the same data to make our predictions for the future or the present. So here we are clearly in an overbought position, clearly where the price is too high and it should come down, but it only comes down to the moving average. So how would you have played this right over here? Let's say, for example, that you wanted to short the market because you know that is overbought and the MACD is starting to reverse to the downside. So you place your short orders and then you ride them until either it has a bounce from the moving average, or if it goes below this moving average, it touches the next moving average or the next support and resistance line. And if it continues to break down this line, then we have more support and resistance, or we have the next moving average. Okay, so the more confirmation you have, the easier it's going to be for you to make decisions on the market. Now, also we need to understand that the more elevated and away from the moving average the price is going to try to come back to the moving average to find some stability. That's what happened in this case. We see that the moving average was providing support and support, but now you see how it's separated from the moving average. So at some point we know that it's going to try to come back to one of the moving averages. In this case, we see that we have an overbought condition right over here. We see that the MACD is all the way at the high and might turn around. We see that the price has been rejected one time and two times, and then it comes down to the moving averages. It comes down to this one, it breaks through it, and it hits this area of support that previously was resistance. And guess what the next moving average is? Right in there. In this case, when it came back up, now this moving average, the 20 moving average, acted as support and then resistance. And look at this, the price comes down and it finds the next moving average. When it finds the next moving average, we find ourselves in an oversold position in the RSI, and the MACD, we find ourselves going into the red. Okay, so why am I teaching you all this? It's because you need to understand the concepts of the moving averages, the support and resistance, the RSI, and the MACD. Okay, all of that is going to come into place when I show you my strategy and how I use my strategy. Okay, it's a combination of all of this plus some more advanced tools into just one. All right, so moving averages help us identify the trend. So now the trend was going up, and at this point, when it crosses the moving averages, the trend comes back down. Okay, so the rule of thumb is this: if the price is above the 200 moving average, right? This purple line, the trend is considered to be bullish, so going up. If the price is below, it's considered to be bearish. So if the trend is bullish, you should always look for positions to buy long, positions to buy here and ride it high, here and ride it to the upside, here, ride it to the upside. If the price was below the 200 moving average, then the trend is considered to be bearish, like in this case, right? So this is a good example of a bearish or a reversal in the trend. Now we have right over here, and starting in February, that the trend actually went below the two moving averages, and now every time it's coming up, this blue moving average, the 20 period, where previously was providing support, now is providing resistance. Look at every time it comes to the moving average, it gets rejected, comes down, comes back up to it, it gets rejected, comes up, comes down, and it gets rejected. So if the price falls below the moving average, you should only be looking for short positions, and if you're doing options, for put options. Okay, put options, vertical options, vertical spreads, whatever you want to do, but make sure that is to the downside. So we know that it crossed below it and it came back one time, it touched this moving average. Now it's a downtrend, so we should not be buying because we're not going to go against the trend. At least now that you are learning how to trade or day trade or swing trade, you should always go with the trend. When you become more proficient, you could do things like buying from here to the moving average and then shorting from moving average down to the downside. But if you just now learning how to do it, just keep it simple and look for these opportunities for when it comes up and then short it because you're going with the trend. The trend is negative at this point. Okay, so let's look at this right here. It comes to the moving average, comes back down. It comes to the moving average, comes back down. It comes to the moving average. Now it breaks through the moving average and it wants to reach this right over here. So what do we have here? We have a scenario where Apple can continue to go get rejected at this moving average or come to this one or even try to reverse the trend and match this moving average. If you see this moving average is heading to this zone, so it is a possibility that the price might come up in the next couple of days to this zone, test this moving average and see if it's going to continue to go up or go down. So let's go to a smaller time frame. Let's go to the 1 hour time frame where you can also identify this. So let me expand this right here. So let's look at this area right here. We see we have an oversold condition, right? It touches this area of support. The price comes back up and it comes to the moving averages and it gets rejected. It gets rejected again on the moving averages. And why is that? Because the trend is negative, right? So once it breaks on this trend right here, every time the price goes up, we should be looking for opportunities to short it, opportunities to short it, opportunities to short it, opportunities to short it instead of going against the trend. If we go to the 15-minute, right, we see the same thing, right? 15-minute chart, we know the price, it opened right here. It opened right here and the price came up. It gets rejected. We already know it's below the moving average, so we should always be looking for shorting opportunities. So we short it. Now the price comes back up. It gets to the moving average. Guess what we're doing? We're shorting it because we want to go with the trend. We're not going to fight the trend. In this case, the market opened low. It comes up and guess what? It never even touches the 200 and then we short it. And then the market comes back up and then we short it again. All right. If it was the other way around, the market opens, comes back down, and then we buy high because we are above the moving average. It comes to this area, it comes back down, it finds support, we buy again. Let's see if we can go a little lower. Let's go to the 5-minute chart. Okay, let's go to the 5-minute chart. And Let's see. Right here, we see that the market, the price went below the moving average. And even though the market started reversing, guess where it's trapped? It's trapped in this whole zone of support and resistance, and we are below the 200. So once it touches 1, 2, 3, we get confirmation, we short it again, right? Look, we shorted. Comes back up, we shorted. If we go against the trend, especially if we're going to hold it for a couple of days, then we might be losing money. Look at this scenario. This is the perfect textbook scenario. It's already below it. It tried to break before the market opened. It tried to break above the moving averages, and it didn't happen. And it came here and it got rejected. It came here, got rejected. Then it came over here. It tested the moving averages, and guess what we're doing? Boom, we shorted because we're below the trend. We're in a negative trend. It comes up, the price comes up again, and it gets rejected right here, right? Once we get confirmation, we shorted. If it came up to the 200, if we got confirmation, we shorted again. And then our target is going to be this area where we have support and resistance. In this case, it came down lower. Okay, let's see here. Clearly below the moving average. So unless there was a bounce above the moving average, we are gonna short it. So we short it, even though it went above it, it failed to stay. But check this out, we have moving averages and also support and resistance. So like I said, it's almost like magic, but it's not. It's pure knowledge. Okay, so don't complicate your life. Just follow the basics and you're going to be on this right side of the trade. All right, guys, so that is the lesson for today, is the moving averages. And there are different moving averages. They have the simple moving average, right? This moving averages, the exponential moving average. They have the VWAP and also the whole moving average. Today, we just talk about the exponential moving average. And why is that? The simple moving average measures the or follows the trend, it smooths out all of this price action, but it's a little slower. The exponential tends to do the calculation a little faster. So now the thing is this, it doesn't measure future performance or future predictions, right? It only tells you what has already happened. Like I said before, all of this has to happen for the average moving average to populate. So don't just look at or depend on the moving average to tell you, to predict an area entry of exit without doing the proper analysis, your technical analysis, your chart analysis. Let's see if we go to the 1 minute. The 1 minute is going to have a lot of ups and downs, but you can apply the same theory. The price comes down and it comes below the moving average. It goes to the moving average. Look, it gets rejected at two critical areas. We have this area that we drew before, that support and now resistance. We have the moving average. It comes down, comes back up. We have the moving average, right? We're in a negative trend. It comes back up. It gets rejected again. Now it goes above it. Now it bounces on the moving average because now it's providing support. Now right here, we have a situation where it didn't know which way it wanted to go, but eventually went up. The trend continues to go up, and we see how the moving average, this blue moving average, provides support. I'm gonna get rid of this box so you guys can see it, but you see how it provided support and support. So the 20 period moving average is a very good tool for support and resistance intraday. The 50 is the next level up, and the 200 is also next level for support and or resistance, but the 200 moving average helps us identify the direction of the trend, whether the trend is up or the trend is down. So let's go back to the 4-hour chart and let's see if we can apply the same concept to another stock. So let's pick another one. Let's go with Facebook. Okay, FB is Facebook. This is 4 hours, the 4-hour chart, and let's look at the past right over here. We see that the 20 moving average was acting as support, right? Until, look at this right here, right? We have an overbought condition right over here. We have a cross in the MACD. Now we have a cross below these areas, below these two moving averages. Now we have to decide one of two things. Now we have the 50-50 chance. We got to say, if the price comes up to the moving averages right over here, if it breaks above it, then this might continue to go up. But if it fails to break through these moving averages, because we have an oversold condition and we have the MACD turning weak into the red, now it's a possibility that the price might come down to the next moving average. And guess what happens a couple days later? So we have that oversold condition, we have a weak MACD, it breaks below it, it hits the 20 moving average, remember 20 and the 50 right here, gets rejected, and then it shoots back down. In this case, it goes below the moving average. Now, here we have a situation where it's oversold, and we have the MACD going from the red to the weaker red. So we have two assumptions. If the price, which is now below the 200, gets rejected at the 200, it might come back down. However, though, if it goes above the 200, then our next zones of support and resistance can be the moving averages, because previously we see that the moving averages were support, now they could be resistance. So what happens, the price comes up and actually gets rejected right at the 200 moving average, but in this case it goes through it, and now it bounces off the 20 and the 50, and they become support for this trend that continues to go higher and in a bullish direction. Okay, so here price comes down, finds the support at the 200 moving average, it stays with the moving average, breaks above the moving average, and now, like I said, everything that goes up must come down. It comes down to find support in this moving average. Okay, and every time it touches, it does a big jump, it comes down to it. In this case, it breaks below it, but it finds support at the 50 moving average, and price continues to go up. Here we have a case where the price comes below both of the moving averages. So now we say, okay, if in the past the moving averages were providing support, now they should provide resistance. And guess what? It comes below it, price comes up, gets rejected at where? The moving averages. And where does it find support? At the next moving average. See that? So we should not complicate our lives, guys. This, all we have to do is follow the theory. We're going to be on the right side. However, we still have to have a risk-reward mitigation strategy in case the trade goes completely against you, and you need to get out in time before you lose all your money. You know, sometimes it's okay to lose 1 and 2% of your investment versus, you know, losing 100% of your investment. Okay, believe me, I've been there, I've done it, I've messed up, and I want to share all my experiences with you guys so you guys don't make the same mistakes that I made. All right, now we're below the 200 moving average. So what we're going to do, we're going to short every opportunity that we have. So market is high, we short it. Market goes high, we short it. Market goes high, we short it. Now we start reversing. Market goes high. Okay, wait, what's going on? Oh, check this out. Right over here, we have oversold conditions. And now look at my MACD bars. They're getting smaller than these ones, right? So it's a very good chance that this might reverse. But why? Let's see if we can do some support and resistance. Okay, I'm gonna get my rectangle and let's see what's going on in here, guys. Look, what did I say? It's almost like magic. Don't complicate your trading. Look, resistance, 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 support. Now a couple days here, it was also support. Now it gets rejected, support. But what's going on? We have oversold conditions. Now in this day, we got support, and now we break into the upside in the MACD, support, and guess what happens? It breaks through the moving averages, and now the moving averages become support. Okay, so the moving averages that were doing resistance now become support. So you see how important it is to apply the concepts that we already know, okay, with the different indicators that we have that we're learning, so that we can make better and more exact predictions on when to get in and when to get out. Okay. All right, guys. Let's do one more chart because I don't want to make this complicated. Let's go to Disney. Okay. So let's see what we can identify right over here. I'm gonna get rid of that. And I'm gonna get rid of this right here. All right. So we see that right over here. Okay. First of all, let's talk about the trend. There's three trends. Okay. There is an uptrend, a downtrend, and a sideways trend. So even though this price was up and down, we can see that the moving average was flat for the most part, right? It was flat for the most part. So you see how it was up, it went down, it was in between them, then it went up, and it was like bouncing. So we can say that this right here was a sideways trend. However, though, now the price gets stronger, and now we have an uptrend, okay? And here we have a little bit of a downtrend, right? And then it looks kind of sideways again right here, and then we have an uptrend one more time, okay? Just like I said before, the 20 and the 50 exponential moving average, or also EMAs, exponential moving averages, they can serve as very good points of support and resistance. In this case, the price went up. So let's look at the RSI. The RSI is showing signs of oversold conditions, so good chance of going up. Okay, let's see if that is an area of support and resistance. In fact, it is, because we have all this right here, all this madness right over here. Okay, so we're gonna put it right in there. So now we know, okay, check this out. It's sitting as support. We have oversold conditions, and the MACD is turning from red, it's starting to go green. Now it goes green, but we wait for confirmation. Our confirmation is going to be the break of the MACDs, or of the EMAs, correction. So it breaks the EMAs, and guess what happens? It goes back up on a bullish trend. It comes back up. So if you missed, let's say you were looking at this and you missed it, right? And you go, oh, I need to get on this trade, and you get right over here just for the price to come down, and you get discouraged and you get out and lose your money. So what is that called? That's called FOMO, fear of missing out, right? So you have to wait, guys. This is like fishing. You don't just throw your line and get a fish every time. And if you do, good for you. Maybe you should teach me how to fish, because I don't ever catch any fish. We just gotta wait and be patient. So we wait. Market comes down to our area that we know has potential for going up, and then we start buying our position. So look at this, right? We trust the process, and we gotta trust our knowledge, and it continues to go up, even though it's already oversold, overbought. Correction, it comes down, and it comes into overbought. It comes down for a little bit, so it gives us another chance to put more, add more to our position. It comes up again. Let's see if it reverses at some point. Yep, it reversed a little bit, but again, we said if it rejects at the 200, now we know that the trend reversed to the downside. In this case, it went through it, and it continues to be up, right? Look at this. It comes up, it breaks below them. We know that there's a target right here, but it didn't even go down that way. It went back up, it found support, it went back up, found support. In this case, the price came down and it went back up, and it looks like it's gonna find support again. However, let's do our support and resistance, right? And we have that area right over here, so it might come up and get rejected one more time, and maybe come back down and find another support. All right, guys, so that is how you use your moving averages. In this case, we're using the exponential moving average in combination with support and resistance, in combination with the MACD down at the bottom, and the RSI right on top. Okay, let me put a line of support and resistance right here. All right, I'm gonna put that right in there. And why? Because see, we have resistance, resistance, resistance. We have some resistance. Now we found support. Boom. Look at that, guys. It went straight into that area and it bounced back up, right? So if it gets rejected, what's the next area? Right over here, right? So let's not complicate our trading, guys. Let's not complicate it at all. And like I mentioned before, you can apply this concept to the other time frames depending on your style of trading. If you see it right here, it breaks above the moving averages. It's a bullish trend. Comes down to it. It's a bullish trend. It breaks below it. Now we know that we've got to find some support at the moving averages. Either that or it's going to reverse. In this case, it came back up, and the trend continues to be bullish. So we find opportunities to buy. We should always trade with the trend and never against the trend. All right, guys, I hope that all these videos are making sense. Believe me, when it comes to the last video of all these indicators and chart analysis, you're going to be like, wow, all of this does make sense. And then I'll be able to share my own strategy with you guys. I don't want to do it just now because you need to understand the concept behind it and not get confused. Okay, so again, if you want more content or you have suggestions or you need a better explanation, just go ahead and leave me a comment. Or if you know how to contact me personally, go ahead and contact me. And again, have a great night and I'll see you later. Bye.